I want to welcome everybody who is listening to this webinar today and specifically thank my friends and colleagues, Shaunna and Kelly. Um, I think that we all know that software and SaaS is an incredibly growing field, and we are delighted to be able to have brought that expertise into SP Liftoff. It is different. When people are talking about a software company or a SaaS company, the metrics and how the deal goes about happening is different, which is why we decided to have this webinar to talk about what those differences are. Let's start off with some overview questions about what is the strength of the software and SaaS market today. Shauna, could you give us any predictions for what you're seeing for the last quarter in 25 and far more importantly, what's happening in 2026?
Sure. Thank you, Sharon. So the SaaS M&A market continues to be extremely strong. It recorded another record year of over 630 transactions completed, which is basically up. The last 4 quarters has been over 500. So you see the continued momentum. On a year-over-year basis, compared to the first half of 2024, it's up 30%, and as compared to kind of Q2 2024, it's up 29%. Overall, in addition to SaaS companies, when you look at software companies, on-prem companies, the broader software market continued to have incredible growth, where roughly 1,100 transactions were completed over the last quarter. And in total, it's roughly 2,300 transactions for the year. So obviously, there's a lot of robust activity. That's a 41% increase over the first half of Q1 24 and the highest 2 quarters since post-COVID Q1 2022. So it's full steam ahead as far as we're concerned in the overall software sector, as well as specifically within SaaS software.
Fantastic. So this is clearly a growing market and it seems to be growing almost quarter by quarter. Is that a fair assessment?
Definitely. No doubt about
Okay.
that.
So tell us about valuations and multiples. When we're working on an M&A transaction, the first question every business owner asks is, how would you value my company? What do you think it's worth in today's market? Well, the metrics for software and SaaS are in fact different than they are for virtually any other company. So let's put that on the table. How are the metrics and valuation methodologies different for software and SaaS?
Sure. Unlike I think historically most people valued companies off an EBITDA multiple, it's different in software. A lot of these software companies, and especially SaaS companies, they're investing so much in terms of R&D and then the go-to-market capabilities. And so with those, they don't have the most attractive, if at all positive EBITDA. So it's tough to be able to value a company. So with that, what they usually do is there's two metrics people use. They use either revenue multiple, or they use what's called ARR, which is annual recurring revenue, and which is based on subscriptions and licenses. So those are the two primary metrics that people value on. When you look at kind of the median overall for the current quarter, it's about 4.2 in terms of the revenue multiple, in terms of determining the enterprise value. And then,
Is
so
that the is that
4.
the revenue is that the revenue
That's the
multiple?
revenue multiples.
Wow. So, I
Yeah.
mean, we're talking about a company that has $10 million in revenue and is a 4.2. So you're saying that company under that metric, if it's
It, it,
appropriate, would
it
be
could
40
be.
million.
Yeah, and that's on the lower end. That's kind of the median. When you look at kind of the average over the quarter, and this is the highest since Q1 2023, the multiple is actually 6.1 times. And it all depends. There are companies that are smaller that may get more of a discount because there's more investment needed. And so sometimes you see those companies trading in the, I would say, high twos, low threes. But then you have premium properties that people are looking at the growth prospects and the opportunity and kind of the established infrastructure to be able to take it to the next level. There are transactions that are being done north of 10x. So it all depends upon, and it all comes down to, which Kelly will talk about in a little bit, the story you have to tell to investors to get them excited.
So let's talk about that just for a moment. You said that there was a 4.2 multiple of revenue. How does ARR work? Annual recurring revenue.
Yeah, so AR, so revenue a lot of times for a software company may include, in addition to the subscriptions, it may include implementation services, it may include training and there may be custom development. Hopefully not. You don't want a lot of custom development. You want to focus on commercial off-the-shelf functionality. But typically an AR multiple is a little bit lower than that. Although when you look at SaaS companies right now, it's kind of one and the same. A lot of it is they have out of the box functionality that the revenue is really the same as the ARR because that's what they're focusing on doing is selling subscriptions.
So you might have a software company, even a SaaS company, that has services in addition to the technology.
Mhm.
And so for valuation purposes, if you're including the services, it's a multiple of the total revenue. But if you're looking for a multiple of ARR, you take out the services revenue, simply look at the subscription revenue and do a multiple of that.
Yeah. And I would say when you look at SaaS companies now, most of the deals we've been working on, the focus has really been on a multiple of ARR. They really don't care about the services. If anything, they view the services kind of a body shop and a hindrance to the overall the business. And so they really only assign value. As much as we push, as you know, they seem to only want to pay on an ARR, which is the subscription licenses.
And what kind of multiples on ARR exist?
So again, anywhere from you can have anywhere as low as 3x. Most of the deals I would say are being done in the higher threes, and then we've seen deals that are over 10x. And there are the exceptions when you look at AI and you look at companies like open source that have a lot of elasticity and scalability. Those multiples could be over 30x. There are the exceptions to the norm, no doubt about that. And then you have other companies, I would say, that are kind of the older technologies. They were developed for on-prem. They're the old commercial model of perpetual license plus maintenance support. Those seem to be trading at a lower discount to the multiples that I commented on. So a lot of those companies are being traded in terms of, I would say, 2 to 3x. There's definitely a discount going on. And I would say the discount has varied anywhere from probably 1 to 3 points when you look at it, compared to a SaaS company.
Okay, you've used the term a couple of times on-prem. I assume that's on premise. What's the
Mhm.
significance of that?
Part of that there isn't a significance. I would just say it's just a different model. I would say that people deploy the technology versus now a lot of the technology is deployed in the cloud. So that's
So
the main
whether it's
difference.
basically is whether or not you're putting it on people's local network or whether
Mhm.
or not it's going on the cloud in some way.
Yeah.
And that really doesn't make a fundamental difference to the valuation, although I'd assume that the scalability for something in the cloud is substantially greater.
Scalability, and then also I think people that the commercial model has moved over from usually it was contracted on a perpetual plus a maintenance, and now people are moving over to subscription. Okay, where you get that reoccurring, which you still could get reoccurring right under a perpetual plus a maintenance model. But the things have shifted over where it seems to be that people want you on that subscription basis.
Let me take a step back and talk again about the valuations and how this is different than other areas of M&A. You know, at SB Liftoff, we do valuations of companies. We see valuations done by others. And we've had situations where a company is operating for 15 or 20 years and their EBITDA is non existent. And we've then seen valuation people come in and say, well, because we can't do a multiple of EBITDA, we're going to do a percentage of revenue, which we then look at and laugh and say, no, you can't say that because you can't do a good valuation, you're going to do a bad valuation and that's going to work. However, this is a different area. This is an area where a multiple of revenue does make sense. Why does it make sense as opposed to the profitability, which is really what buyers generally care about? How is software different in that regard?
Yeah. When you look at the buyer pool, right, that's investing in these type of companies, a lot of them are strategic buyers. And I would also throw in that camp, PE-backed strategics. And so with that, a lot of times these companies are bought because they're a bolt-on, a technology bolt-on. And so they come with an infrastructure that has the go-to-market and the marketing capabilities. And so with that, it's just a matter of kind of filling in that void within the portfolio and then leveraging the existing installed base and the infrastructure you have for that company. So that's why it's viewed a little bit differently. And I would say, unlike companies that are like HVAC or electrical contractors or rigid companies, the pace at which software is developed and evolving too, the dynamics are very, very different. Okay. It's really critical to be kind of on the cutting edge and continue the innovation with software. So a lot of times the focus is building out the product and realizing that you have a commercially viable product. And then once you get that, then you start investing in the actual infrastructure in terms of the go-to-market and marketing.
So if somebody is a buyer and they already have that, it's almost like they're looking at in a non-SaaS software company. Sometimes people look at gross profit as opposed to net profit, saying that we're going to see all sorts of synergies, so we don't have to worry about what's below the line. We only care about your gross profit. In this case, it sounds like you're saying it's really the software core, and that can get plugged into somebody else's back end corporate structure. Is that a fair
Yeah.
assessment?
Yeah. So the way you look at it from a software people perspective, people are looking at is this is a technology bolt-in that fills a gap. I could cross-sell that into my installed base, right? And you could continue to kind of expand your share of wallet with that particular customer. You know what I'm saying? And then from there, you could continue to evolve that overall offering to be able to enhance and grow that revenue base over time. So that's
Like,
it's a very, very different type of, I mean, I'm sure in the, the regular kind of hardware world, right? They try and do the same, but the impact and the multiplicative effect is much greater, it seems, in the software side. And so that's
like
why you see the valuations you do. I know a lot of people that have done traditional kind of heavy metal or kind of old line M&A, when they come over to our world, they just can't believe it, you know? I will say that private does look at QOV. They do look at rule of 40, right, in terms of gross and the overall EBITDA margins to see if you get there. But it doesn't seem to be as emphasized, I would say, in our world as it would be in some other more mature industries.
Well, I'm going to ask Kelly a question because he's explained this to me twice already. And so I want him to describe it to the audience. Let's talk about the rule of 40. It's something that, when you're first getting into the software and SaaS side, rule of 40 is just constantly comes up. But then the question becomes, what the heck is it and what does it mean? Kelly, would you mind talking to us a little bit about that?
Of course not. So the rule of 40 is a great metric applied to software companies, where it's really the combination or the aggregation or the addition of two percentages. Really, one is the growth rate, and the other is the profit margin. When you add those up, and those are really counterbalancing in many cases. So a startup company may have tremendous growth on the top line in terms of recurring revenues, but their EBITDA, their bottom line is really low because they're plowing everything into the business to grow, to continue that upward trajectory. That's a less mature software company. In the case of a really mature software company, they may have less growth because they've perhaps saturated the market, maybe they're competitors, but at the end of the day, their margins are going to be higher because they have a more mature operation. So less growth on the top side, but better margins. If they add up to 40, it's still considered a really strong company. Now, I just gave two examples at two ends of the spectrum in terms of the maturity of a software company. In the middle might be someone who still has pretty good growth and increasing margins. And again, adding those numbers up, if they exceed 40, that's considered a really healthy and attractive software company.
The rule of 40 is an important thing to take away from today's webinar.
Indeed.
Shaunna, I've got one more question for you. You mentioned strategics, you mentioned PE, and of course, strategics backed by PE. Are those the primary buyers? Are those the exclusive buyers for software? Are there other strategics or other any searchers who might be the potential buyer for a software or a SaaS company?
Yeah, roughly two-thirds of the market right now is strategics, or people that already participate, right, in their business's software or have software as part of their business. And then there's PE-backed strategics that already have a portfolio that includes, an asset that they want to do a bolt-on to. Combined, those are about 64% of the market, but the balance of the market includes other PE firms looking to invest into these platforms. So it'd be a new opportunity for them. You have a lot of search funds. You have a lot of high net worth individuals that are looking to invest in the space. So, about a third, a little over a third of the market includes other people that are non-strategic today, but trying to make inroads into the sector, given kind of the high growth prospects, the reoccurring revenue stream, the attractive margins once you get over the hump and everything.
A little bit about what makes a software company uh, attractive, which is, you and I were talking a couple of days ago, and you talked about compliance. Some type of software that's necessary. It's not somebody ever going to buy a software and say, "Oh my God, I love this. I actually want to spend $100,000 and improve my back office." It's usually some compelling need. Could you describe that a little bit, please?
Sure. And I think, I was using an example last week, Sharon, when we were talking. There was a company that basically developed technology that basically provided um, data connectivity to various edge devices and everything. And they had taken an exorbitant amount of money and really nothing to show in terms of in terms of kind of what they've done with that money. And Kelly was participating in this client meeting, and at the end of the day, it was basically it was like a software offering looking for a specific use case. They hadn't really figured out who they wanted to grow up to be. The best type of software companies where I think people get excited is there's a strong underlying business driver. When you look to put in software, it's not necessarily about just putting in a product. What you're really doing is you're changing the culture and the process in terms of what people to do, right? You're looking to automate something, you're looking to meet compliance requirements and various things like that. And so, with that, given the dramatic impact that software has when you install it within an organization, people don't want to undertake that effort unless there's a reason that you actually have to do it. So, what are reasons that drive people to want to do it? There are a lot of industries like the water, a lot of public utilities, water industry, pharmaceutical, the aviation industry, aerospace and defense. Right? There are very stringent compliance requirements that those industries have, and so the best way to do that is to use software as your digital backbone to be able to collect the data consistently, be able to report it, right? Get the metrics that those agencies are looking, those customers need to report out to those agencies. So compliance is a very good thing. Another thing is there's certain other things where companies you see a lot of times in the food industry, all of a sudden, boom, there's some salmonella outbreak or something like that, or a product recall you'll see. Those are other reasons why people want to mitigate that risk in industries where the outcome could end up in death or harm to people, right? So again, you want to look at industries where is there an underlying business driver like compliance, things like that.
Talk a little bit more about, let's say, the food safety situation.
Mhm.
There is a company that is producing a food service, a food stuff of some sort, and they find out there's salmonella. How does software help in that?
Sure. So software basically could provide from cradle to grave the full traceability of what actually goes into, say, an Oreo cookie. Okay. And so
I
the
don't want to
worst
know.
thing, the worst thing you want to do, right, if you're making Oreos, if you have absolutely no visibility to what went into the product and the specific batches that were produced, right? If anything, if there is some sort of contamination or some sort of issue, you as the maker of those cookies want to be able to isolate it down to that specific lot and batch, right? And so software allows you, there's a software application called manufacturing execution system. It provides that traceability and genealogy capability, so you know exactly what went into making that product, what lot, which batch, what particular package.
So rather than pulling back all Oreos from across the country, you can say the problem was in St. Louis. We're just going to pull those, but everybody else is fine.
Yeah, yeah. My former employer, I work for GE. GE had an issue where they had a problem with one of their lines of dishwashers, and they actually caught on fire. And there were a few fires that burned down houses, believe it or not. And so what happened was they had to pull the whole lot. It was over 40 million in inventory. I mean, what a disaster in terms of financially the impact the company had to take. Had they had the right traceability and genealogy software, they would have been able to isolate it to, hey, it was this, shift of dishwashers where we had this issue or related to this particular part.
Got it. Okay, Kelly, I'm coming back to you. You've been the owner and I guess the seller of a software company. What are the things that people who have a software or SaaS company should be thinking about to prepare your company to go to market? How do you know when you're ready to go to market? What should you be doing to get ready?
Great questions all, and the reason that a good, experienced M&A advisor is important. And I know this sounds a little bit self-serving, but even as a business owner then, I didn't know what I didn't know, and I learned a lot of great lessons. And through the many deals now that we've been supporting, we always give the guidance to owners. You have mentioned being prepared, absolutely critical. And some of that may require some patience. And that is very difficult, but you need time to make sure that your company, in all aspects, operationally, financially, technically, legally, is ready to go to market. At the end of the day, you can sell next month or next quarter, you can go quickly, but depending on the market conditions and dynamics, depending on how ready your company is, you may be leaving a lot of money on the table. And this is just in terms of recurring revenues, top lines, the multiples that will be applied against them, because many of our owners, we find with some careful preparation, they can optimize and essentially, let's say optimize the valuation through changing or updating or streamlining or making more efficient their operations by taking care of some of the, as we're going to talk about, making sure that the metrics that software buyers are interested in, making sure that those metrics are accurate, easy to report across the number of different years. So I've touched on it here. Having your books in order, accurate, clear is really important. I know this seems silly, but many times we're dealing with startups, for instance, who, finance may not be their forte. They're technical people. Look, they're fulfilling orders, they're getting things done, they're growing fast. Everyone's doing a little bit of everything. But and we're not saying that our owners, we don't recommend, you don't have to be a gap compliant, but you definitely have to have standard accounting processes, clear books, and making sure that your books are able to report against some of the standard KPIs that software buyers will require that you report and verify. So, for instance, talking about those KPIs, and most of these are specific to software companies, things like annual recurring revenue, ARR, Shaunna has touched on it. You touched on it briefly. Net revenue retention, gross revenue retention, and the flip side of those two metrics is churn, and that is the loss of subscribers. Now we're talking, I use the word subscription, so we're talking about recurring revenue, but these will apply. And as we've said, kind of a SaaS model is going to have the most favorable multiples. So I'll focus a little bit more on a software company that is more SaaS oriented or subscription or recurring revenue oriented. So those metrics are really important. You need to be able to articulate as a business owner where and how you are losing sales, gaining sales. So downsell, sell, cross sell across your portfolio, bringing in additional sales. That's important. Other metrics that are important are your pipeline and your sales velocity. And I know everyone that's attending today has heard these terms and is familiar with them. It's absolutely critical that our owners are ready to accurately report these. So this is some of the setup that will generally guide our clients to to uh, to prepare. And it does take patience from everyone involved. A few other, I'll just run down a real quick checklist. Some of the other things, and this is why it requires preparation and some patience. Our clients need to be able to, as Shaunna has nicely articulate themselves. What is the value proposition? What are the use cases for the use of their offerings? Now, as we've heard, that value needs to have address a clear business driver. You need to be in a market that is growing and strong, where you have competitive differentiation, right? Your competitors aren't eating your lunch, you're eating theirs. So having those really clear use cases is super important. And some of our clients have more difficulty preparing that than others, and that's okay. There's, of course, lots of documentation that we know needs to be done. We want our clients to have a very strong cybersecurity posture, not only in the offerings that they're rolling out to market, but even in all of their internal systems and networks. And I'm just running through a checklist here, so I could certainly go down a big rabbit hole, but another
Well,
important
I'm going to
one.
stop you
Please,
just for a second, Kelly.
please.
You mentioned net revenue retention. And to me, and I'm assuming G revenue retention is gross revenue retention. Um,
Yes.
it feels to me like you're looking at a trade-off between do clients, do customers come in and buy it and keep it, or do they keep it for 3 or 6 months and then get rid of it? So the flip side of that is churn. So if you're getting a lot of new customers, that's great. But it also matters how many of those customers stay with you or whether or not you have to consistently be refilling that pipeline. Is that a fair assessment?
You're right on, Sharon. Keep in mind, remember we mentioned Shauna started out today talking about how these multiples are based on companies, software companies that have recurring revenue. So holding on to those customers over time, which means consistently demonstrating value, increasing the value that you're demonstrating to those customers, perhaps expanding the value over time. That is very, very important. Uh, so, but you touched on, you're adding new clients. That's terrific. If you're in a growing market, you have a demonstrated offering that addresses, mitigates, certain business drivers in a positive sense. That's fantastic. Adding new logos will help your top line. But when we get to revenue retention, whether it's net or gross, and there's just slightly different formulas, it's really important that you maintain your foundation of customers. They continue to subscribe because you're delivering value to them. Again, that's going to hold up your recurring revenues. That's going to then have more favorable multiples applied against them, resulting in higher business valuations.
Um,
And Sharon, if you don't mind, I mean,
yes, please.
one of the things that we didn't emphasize, I know we've been focused on AR and net revenue retention and GR. One of the other metrics that people look at in software is kind of the overall lifetime value. So like I think I alluded to, there's the multiplicative effect. Once you secure a customer, there's an expectation that you're going to grow within that customer's installed base, whether it's new users, new features and functionality, or new locations, that there could be anywhere from a 3 to a 10x with that one customer. And so that's the other thing that people do look at. And so that's why it's important that you get in there, you continue to retain that customer, because the expectation is you're going to grow within that account and expand your share of wallet.
I was talking to a company outside the software and SaaS industry that basically was growing very rapidly, but they lost about 30 to 50% of their customers every year. So they were treading water really, really fast, but the growth rate was pretty small. I would assume that would be a negative marker for a software or SaaS company. People are trying it, and they don't like it, they move on. So you found somebody new to take their place, but that doesn't give you the same kind of multiple that you otherwise would get. Is that a fair assessment?
Yeah, I mean, I think there's two things. One, you're correct, right? They've moved on and maybe there's someone else, or maybe just having software didn't work for them, right? It's too big a leap of faith here. The other thing that I would question when you look at a company and you hear those type of dynamics is I question whether it actually was software. Okay.
That's interesting.
It could just be a project that they deployed. And so the challenge that they're having is the extensibility and usability is very limited because it's only to whatever was implemented, right? As you look to kind of evolve the technology to better suit your needs, it may not be there if it's not an actual software product at the end of the day. And that's what we find with some people is they think they have software, they don't. It's project service business or it's custom development. And so those, I would say everything we've talked about, you could basically throw out the door with respect to valuation.
What are the IP issues with a SaaS or a software? Essentially, it is intellectual property.
Mhm.
But is it truly protected because you don't need to change a lot of code in order to, so it feels like people need to be running at full speed just to stay ahead, and that simply having a patent is not going to be a tremendous amount of protection.
True.
What do you think?
At the end of the day, it's really the people, right, that have created this software as well as continue to evolve the product. So it's the retention of those people probably is the most important. Sure, you could go out and get a patent. I would say in the software side, at least with the companies we've dealt with, I don't know if you necessarily get any type of premium by having a patent. I think you could do things more cheaply. If you ever get into a lawsuit situation, you could go out and file and get, copyrights and trade secrets on those processes. They're a fraction of the price. So I would recommend at a minimum, at least doing that. So if you do have some sort of issue on infringement or theft or whatever, you've got kind of the backbone if you go to court to be able to deal with that. But Lord help if you go through that process, which I wish went on anything. I think the most important thing, and this I can add on to kind of what Kelly was saying before, was it really comes down to the people. I mean, software, we don't have, manufacturing plants and a bunch of inventory. At the end of the day, it's the knowledge of the people themselves. So you need to make sure you take care of that team and staff the team appropriately. Okay. The other thing that helps to provide is an insurance policy. One of the other things that you could do in terms of preparation, and I guarantee you a PE firm is going to outsource the technology due diligence, and they're going to come in with a firm that is going to basically, gut the place. And so with that, it's really important that you have the right documentation, right? The right processes, right? All those type of things should be documented. If you can automate testing and things like that, those are things that you could do that are going to make you attractive given the amount of money that's coming in from the PE sector. I would highly recommend that to entrepreneurs that have software, is as much documentation that they can have in terms of their development, their sprint cycles, support tickets, new features and functionality, their testing. All those things are documents that people look at. And those are things that we look at in preparation when we bring a company to market, right?
Um,
Because again, if you don't have those, then you're relying on that development team. And what happens through a change if that development team doesn't stick around? At least you have the documentation and how they did things.
Okay, so you've got a buyer and they're doing tech due diligence. They understand that your software does this, and then they're going to do a deep dive into your software. What protections, if any, does the business owner have to protect their IP during this due diligence process? Because no deal is done until the money crosses the wire. But you are certainly opening up yourself to somebody who could say, well, we're not going to buy you. We'll just duplicate this.
There's always risks, no doubt about that. A lot of times they use a third party firm, and you could kind of keep a clean team right separate. So you kind of mitigate that downside risk in terms of competitive type situation. You are not sharing source code through the process. You don't need to. And we don't allow that to happen during due diligence. But a lot of it is spent in terms of, cybersecurity, the architecture of the product, the extensibility, the scalability, your your testing procedures, and just kind of your overall management of your roadmap and things like that. So all those things you could kind of keep that are not necessarily that proprietary, but again, you give them what you need to do and nothing more. Let's put it that way. That's our role.
Understood. Um,
Okay.
I've been contacted by a number of business owners who say, we've just developed this fantastic software. It's going to change the world. It's going to do all of this, but we've run out of money and I don't have the time, patience, or mental ability to keep going. And they come and they say, we have no clients. We've done a couple of demos, but that's pretty much all we've done. My statement to them has been, you got to have some clients, you've got to show some growth, you've got to show something. You can't simply have the software. Is that right or wrong?
You're right on. I mean, at the end of the day, you have to prove that it's commercially viable and people want to spend money for it. Otherwise,
Got
you don't really have, you may not even have a product, right? And then if you have a product, it may not be something that the market wants to spend money on because there's no compelling business driver to be able to want to open up your wallet and spend money on that.
So the documentation is really important when somebody's doing the due diligence, but it also kind of indicates that you thought these things through and you
Mhm.
have some experience. And so again, that goes back to Kelly's point about the timing. Kelly, I'm going to come back to you. How does the sales process differ for software or SaaS? I mean, as we all know, for the usual M&A process, um, M&A advisor works with the seller, prepares all sorts of materials, goes to market, gives out teasers, etc. It's a little different in the software system. Kelly, how does that work?
It's a little different, and my answer will be pretty short. At the end of the day, Sharon, the steps are all just very, very similar. It's not that the overall process has changed, but what is different is how we approach. Based on our experience, one of the big changes in the front end, you're putting together a sim that is 40 to 50 pages to send out to your prospective buyers to inform them about the company. We have found with, software companies are generally more complex, more sophisticated, and generally buyers of software companies are more sophisticated as well. We have had great success with, let's call it an abbreviated SIM or an overview or even a teaser, where we get in a standard structure between 10 to 12 pages instead of 40 to 50, a great overview of the important elements of the company that are going to tell the buyers right up front if they want to pursue that acquisition or not. So that's one of the changes. One of our differences. One of the other differences is, and we've touched on some of these, the metrics, the IP considerations, a lot of the technology. There are just additional layers, so you're going even deeper throughout the process, from documenting it through in due diligence, validating all of that. So those are two of the biggest differences. We've had great success with an abbreviated SIM, and then also when you're in due diligence, there are just so many the deeper layers that you have to go into for any technology or software company sale.
I think
Take a question
Sharon,
from the audience. Yes,
oh,
Shauna.
I'm sorry. I think the other thing too that's different is, unlike a lot of times when you bring, say a widget to market, right? A lot of people are focused on that widget, the features, the functionality. With software, we include use cases, and the reason why is it's all about telling the story and getting people excited about why this particular industry and this software company within that industry and how you could win if you're an investor in that. So it's very different, I would say, relative to other SIMs, right? Having done the $20 billion worth of deals, some of those were on the buy side, right? And reading through SIMs, I didn't see a story. I just saw kind of bits and pieces about the market, the competitive landscape, right? The features and functionality, the go to market. The goal when we put things together, as you know, is to be able to stitch that all together in terms of compelling story to get people excited.
One of the questions we received from the audience is about AI. Big surprise. How does adding AI to a SaaS platform affect valuation?
So it depends. Just saying, and you see this also not only with AI, but analytics. Everybody feels like, wow, if I include AI and analytics, I'm going to get a premium in valuation and my company is going to be more attractive. Again, if the AI capability does not address a business problem where there's a need, it doesn't really matter because there's not a compelling reason for people to buy. Okay. It may perk up people when you say AI, but it doesn't necessarily mean that you're a shoo-in in terms of getting the deal done as well as a premium valuation. The other thing to think about is what type of AI are we talking about? Are we talking about an AI such as like an open source or some of these AIs where it's highly scalable and extensible that it could be consumed with value by a huge group of people, right? As their backbone, as they're looking to kind of develop their own software. So you see, like, OpenAI and open source, those have big value because the consumption is great. And so they're being rewarded with premium valuations. Versus if you look at some generative AI that may be specific to a vertical application, that value may be a fraction of what some of the open source and open AI technologies may be valued at because it's very specific in terms of addressing a need within a particular vertical. So just saying that your AI is not necessarily guaranteeing a shoe-in that the company is going to sell, let alone the valuation. It all depends upon the usability and the scalability of that AI.
I think that there's generally a sense that if we can say that it's got AI in it, oh my gosh, that's going to change things. And what I heard you say is not really. If the AI actually supports the basic functionality, that's terrific, but it's still the functionality of the software that matters. And we get back to the rule of 40 and the growth rates and all the rest of that. So as AI is more of a tool and it's only going to add value if in fact it's adding value, but simply having the AI there does not per se add value.
Yeah. And it's not just AI. You hear, there was there was a lot of buzz in AI, analytics, machine learning, natural language processing. These are all things that people got excited about. And there was a tremendous amount of money that was invested in, say 2021, 22. And what's happened is a lot of those people were kind of looking for the business problem and they haven't provided the returns back to investors. And so investors today are extremely selective when they're looking at these type of assets. It's not as easy, I would say, had it been back in the 20 when you had all the hype. Now people are a lot more selective and they want to understand what exactly are you doing? Are you delivering value? Or is this just a nice to have? Because if it's nice to have, it's going to be a long putt in terms of the sales cycle then.
Got it. How do channel partnerships drive value? I mean, there's so many different ways of going out to market, and we've already said that you need to have a software that has customers. What if you have channel partners as opposed to direct sales?
I would say amen, 100%, full steam ahead on that because we see, hey, Kelly and I were just on, we were kind of mentoring a company. We do this a lot, right? As former business owners, we know the scars and what not to do. Right? And we want to put people on the right trajectory. So we were actually talking to a company that provided compliant software. I think there's a strong business driver there. And the owner of the software company had realized actually a successful exit on another business of his. And he was looking to plow, 4 to 5 million in a direct sales force. And we looked at him and said, no. Okay. When you look at your software and kind of the dollar price and kind of who it would be attractive to, we said this would be a channel play. And so we included a team member of ours that specializes in building third party distribution, whether it's distributors, whether it's reps, whether it's solution providers, system integrators, or whatever. I would say, especially a lot of the lower middle market companies, try and see if your software is able and you can articulate easily your value proposition. Definitely use third parties because people know when you direct in a direct sales model, a lot of times those are expensive people. And a lot of times those people, in order to get traction, you're sitting 18 to 20, 24 months out. And frankly, having been a small business owner, that's a long time to wait. Okay. Versus I could go out and cultivate relationships with 10 channel partners. Now I have a lot of irons in the fires to de-escalate the risk.
One of the things I'd like to actually hear from both of you is tell me about the ideal software transaction. What does that company look like? What are the characteristics that you say, wow, that's going to be very exciting? Because what I've heard you say is you can't simply say it's a software or it's a SaaS deal because it may be a software or a SaaS for something that people don't really need. It's more of a hobby. So there needs to be some compelling business purpose why people are going to buy this. What are, give me a case study of an ideal software transaction. And Kelly, get ready because you're coming next.
Okay. So the first thing that I would do, and I'm going to start off a little bit differently because we've run into this situation. A lot of times when these software companies are founded, they have very complicated cap structures. So the challenge is when you go to sell the company, you have very different perspectives on that. And so a lot of times I feel like we're in the position of playing therapist. So first thing you could do is if you could first simplify the the capital structure, right? And make sure everybody's on the same page because you would surprise that's not necessarily the case. Okay. Um, the other thing I think you could do is, like Kelly said, you need to have my ideal software company would be a company that basically has at least 90% out of the box functionality. So it's a product that is very low in terms of implementation service. If anything, the install actually could be done by the customer. So then you don't have to worry about having a bunch of bodies that are going to do the install that you're going to get no credit. And as an advisor, right, we have to explain to the owners of the company that you aren't going to get any value assigned to the implementation services. So again, you want at least 90% out of the box functionality. The other thing related to the software, it's great to have out of the box functionality, but the other thing you want to do, given that you have to configure the system to each customer and it's unique, You want to be able to build the configuration capability and the tools within the system. You don't want to have an out of the box software package and then all of a sudden you're doing custom development, because then you have to support all those installs. So again, out of the box functionality, configuration within the system, native cloud, ideally, multi-tenant, multi-instance. I apologize, I'm getting a little technical here for you, Sharon, but I know some of the people participating in this webinar will understand that. Okay. And then Kelly, I'll let you go on from there.
Yeah, I think it really, most of the things, and Shauna just hit a nice checklist, but you've we've heard the same themes throughout, and these are things that do define a good software deal, a good software company. Compelling business drivers that are addressed with your software, so value delivered in a market that is growing or in a market that has lots of opportunity within that market. uh, we keep hearing about value delivered, business drivers addressed, recurring revenue. Shauna just hit on cloud functionality, out of box functionality, a lower services component, kind of a get started really quickly so that it scales quickly. And we even touched on direct versus indirect. Um, so yeah, so far this is a great list, and there's been recurring themes. So our visitors here have heard a number of very important things several times, and that's by design because they are incredibly important. And then on the downside or the flip side of that, having project oriented, having to go out and hunt for new customers over and over again, as opposed to having retaining customers. Having multiple versions of code out in the field, or maybe you're maintaining, it just gets complex, and that's going to weigh things down. So yeah, so I think a number of ways we've described pretty clearly some of the main positive elements of a good software company.
Yeah.
So a
And maybe
company,
Sharon, oh,
go ahead.
I'm going to say specifically, I think you have to be at least 2, if not 5 million in annual recurring revenue. Okay, whether you're profitable or not, you should be at least break even. Okay, I think your retention has to be at least in the low, if not mid 90s. A lot of times people are looking at 95% plus in terms of your retention. Okay, you've got to be adding new logos. So they want to see a robust pipeline with pretty high conversion, and that you're adding logos each year. It's not a matter of just kind of living off the install base and selling further within that. Those are other metrics that people are looking for as well. And then again, because software businesses are so heavily dependent upon the knowledge of the people, as much as you could diversify the risk by having, a third party channel to market, right? That kind of mitigates to a buyer to say, okay, Tom, who's our main sales guy, if he's frustrated and wants to leave after the deal is done, listen, we've got these 10 channel partners that are going to continue to grow the go to market capabilities for us.
Makes perfect sense. So, what I heard Kelly say just a moment ago is that ongoing revenue is incredibly important, whereas project-based, a lot less so. So if it's a software that people will buy and use occasionally, that is different than somebody who's using it on a regular basis, for an ongoing intrinsic part of their business or personal needs, as opposed to, I have it for this purpose and then I'm done.
That
Got
just
it.
gets to the value delivered, Sharon. At the end of the day, you're just talking about, does it deliver value consistently and over time more value, hence higher multiples, higher valuations.
Got it. Got it. Got it. Got it. One question came in from the audience, a little bit techie, or technical. What is the preferred accounting system for SaaS companies? I mean, can they still be on QuickBooks, or do they need to be on a more sophisticated system?
No, it's fine if they use QuickBooks. But I think the biggest challenge we found, especially in the lower market, is people will have an accounting system, but they don't always use it. They'll manage through Excel on top of that. And it's fine if you're on a cash basis, right? We could get it over to an accrual as well, right? And work with you guys, but it's fine. That I've never seen a buyer that has discriminated or penalized a company because they're using QuickBooks, but it is good to have some sort of system in place.
Yes, and certainly I've done a number of deals where people say, "Well, here are my financials, but now let me give you the Excel spreadsheet that it really is how I manage the company." It's like, okay, before we go to market, these two need to be aligned. We need to understand what is system you're using to run the company, and the fact that you have QuickBooks or Peachtree or whatever else might be. We need to get those in alignment. Is that something you see in the software and SaaS area?
Absolutely. And the expeditious way to get through due diligence is if you have QuickBooks Online and you're able to provide the buyer with access. I mean, obviously you could hive off like the bank access and things like that. But I could tell you again, QuickBooks, they don't mind. We've never had an issue where people walk because people use QuickBooks. You just
Well,
need to stay with QuickBooks versus QuickBooks and Excel.
got it. Now, we actually, when we have clients who are using QuickBooks, we get access to it, but we don't generally give the buyer to it. What are the kinds of professional advisory help that somebody needs? If you're a company, you're looking at your software saying, I want to go to market now, I want to go to market in 2 years from now, whatever it might be, what professional advisory help do they need?
Yeah. The first thing that I would recommend, which people don't understand, and I know you all too well, so I'm preaching to the choir here, the value implications is I would have people first sit down with their financial and their tax advisors because I don't think they really understand the impact in how you structure deal and the net proceeds and how tax can make a huge difference in terms of what you actually take out of the deal. So our recommendation is first to go talk with your financial advisor and your tax advisor, and because that helps also set kind of what money do you need to be able to retire or do what you want to do with your financial advisor. And the tax guy usually comes in, tax gal or guy comes in and provides advice in terms of what the net is you're going to take from the deal. The other thing that we encourage people to do, and we do this right because we care and we want people to be on the right trajectory, is and it's always tough for business owners to be able to digest, but pull someone outside the company, and we're happy to go ahead and do this where we'll go ahead and look at your company and say, are you ready? Are you focusing on the right things? We were just on with a company recently where Kelly knows they were building out all these bells and whistles on their technology, and they should have stopped after the first module and they should focus on the go to market capability, right? But for some reason, that company was being consumed and run by the R&D team, which was the wrong, that's what we told the owner. So I think having kind of a third party come in, look at the tech stack, whether you decide to hire someone or if you have a buddy that understands, I would encourage you to do that because again, what people are looking at the end of the day when they're looking at buying these deals, they're looking at the installed base and all that, but it's really the technology that's going to drive the future value.
Um, that makes a huge amount of sense to determine what is. SB Liftoff does something called an M&A readiness assessment. And it sounds like that's incredibly important, not only in most deals, but also in software, because there's going to be certain metrics that will be different. And really understanding that 2 years, 3 years before you go to market gives you the flexibility to make the changes in the company necessary to drive that valuation when it's time for you to exit. Too many people wait until I'm going to be selling in 6 months, so let me have the assessment done now. No, it's so much easier if you know what the target is, if you know what the market is looking for, and then aim for that. If you decide that you don't want to, you're the business owner. You get to make that decision. But boy, isn't it good to know what it is the market's going to value in your company while you're still working on it.
Absolutely.
And Sharon, if you don't do that preparation, you're leaving money on the table. End of story in almost all cases.
Fantastic. Well, listen, I very much want to thank Kelly and Shaunna and the audience for the questions that we received. We're going to be doing a second version of this webinar in October, and I'm going to turn this back over to Jennifer.